All right, today we're going to break down a really fascinating market report from FFN Still. Now, this was written back in early March of 2026, and it laid out a super clear data-driven game plan for how to position for the next 6 months.
And it gets right to the heart of a problem that, let's be honest, every investor faces. When the market is just throwing all sorts of confusing signals at you, how do you figure out where the real opportunities are? It's a tough puzzle to solve.
So in this explainer, we're going to walk through their analysis step by step. We'll see exactly how they used hard data to cut through the noise and build a really strategic framework for what was coming.
So where do you even start with something like this? Well, you've got to start with the big picture. Before you can even think about picking a sector, you have to decode the major clues the economy is giving you.
Now, according to the report's model, the economy was in what's called an early cycle recovery. This is usually the sweet spot. The Fed starts cutting rates, manufacturing is getting back on its feet. It's typically a green light for growth. But, and this is a big but, it wasn't nearly that simple.
And here's our first major head-scratcher. While the economic model was flashing recovery, the average consumer was feeling incredibly pessimistic. I mean, look at that. Sentiment was down a whopping 21% from the year before. That is a massive disconnect between the data and how people were actually feeling.
Okay, now let's look at the bond market. For the longest time, the yield curve had been inverted, a classic warning sign for a recession. But it had just turned positive. This steepening of the curve is historically one of the most powerful signals you can get that a major shift, a major rotation, is about to happen in the market. This is a huge, huge clue. And then, on top of all that, there was this massive geopolitical shock. A conflict in the Middle East had choked off about a fifth of the world's oil supply. Now, this isn't just a news headline. It's an economic earthquake that sends shockwaves through literally every corner of the market.
So you've got all these pieces on the chessboard, a gloomy consumer, a steepening yield curve, an oil shock. So what was actually happening under the hood? Well, what was happening was a massive changing of the guard.
And wow, this chart just lays it all out, doesn't it? I mean, look at the returns over 13 weeks. You've got materials and energy just screaming higher, both up over 20%. And then you have tech, the market darling for years, barely up 3%. The difference in performance is just staggering.
So the big takeaway is this incredible passing of the baton. The old leaders, think of your high-growth, rate-sensitive tech stocks, were getting left in the dust, and these new leaders, defensive, commodity-heavy sectors, were the ones taking charge.
Okay, so that sets the stage. Now let's get to the good stuff, the solution. How did the report translate all this data into an actual, actionable game plan? They focused on 5 key sectors. And here's the roadmap. The report identified 5 specific sectors for an overweight position: energy, utilities, consumer staples, industrials, and financials. So let's dig into the why behind each one. First up, energy. And this one's probably no surprise, right? It's the most direct way to play that chaotic macro environment, basically riding the wave of that huge geopolitical supply shock we talked about.
The data tells a really clear story here. You had huge returns in oil prices surging, but, and this is a really big but, the sector ranked dead last in terms of its fundamental health. So this was a very tactical, high-conviction bet, but definitely a high-risk one.
All right, next up, utilities. So if energy was that flashy, high-risk trade, you can think of utilities as its total opposite, the quiet, underappreciated, defensive winner. And the data here was pretty compelling. It was the best performing sector over the last month and had the highest regime resilience score, which just means it tends to do well in lots of different economic environments. Plus, it had these 2 awesome tailwinds: falling interest rates from the Fed and that booming electricity demand from all the new AI data centers.
The third overweight call was on consumer staples. These are the companies that sell the stuff we all have to buy, no matter what the economy is doing. The whole idea here was just quality and stability.
Now, check this out, because the data points they found are just fascinating. Staples ranked number 1 for fundamental health. It directly benefited from that weak consumer mood, and get this, it had a 100% buy ratio from members of Congress in their recent trades. I mean, come on, that's a pretty powerful signal.
Okay, last up, we've got a 2-for-1, industrials and financials. The report grouped these together because they weren't just defensive plays, they were seen as these really interesting turnaround stories where the fundamentals were getting better.
And they each had their own unique catalyst. For industrials, their health scores were on the up and up, and they were getting a nice boost from a weaker dollar. Meanwhile, financials were showing the best health improvement of any sector, and that was driven directly by that steepening yield curve we saw earlier, which is great for their profits.
But let's be real, no forecast is ever perfect, and a good analysis always talks about the risks. So the report was very clear about what could happen to completely blow this whole outlook up.
They called these the kill switch scenarios. A sudden peace deal in the Middle East could make oil prices collapse, wrecking the energy trade. If inflation came roaring back, the Fed would have to stop cutting rates, which would hurt utilities. And of course, a big credit crisis would just throw everything into chaos. You absolutely have to know the risks.
And of course, it's worth pointing out that all of this deep dive analysis, from the macro models to the sector health scores, was all powered by the data and the tools inside the FefInstill platform.
So what's the big takeaway here? I think it's that in a really complex and confusing market, having a data-driven framework is your best possible guide. If you want to read the full report for yourself and check out over 300 free learning concepts, just head over to fminstill.com. And for more data-driven explainers just like this one, make sure you follow us. Thanks for watching.